Hi friends, welcome to my channel. Good morning everyone. Today our topic is concepts of accounting. This is a very important topic because these are the concepts, these are the assumptions on the basis of which the entire accounting is built. If we understand these concepts, we can really understand and we can really enjoy the entire accounting subject. If we don't learn these concepts, always there is a state of confusion in our brain. So let's go to learn these concepts. The first concept is business entity concept. This is also known as separate entity concept. What this means? This says business is separate, its owner is separate. These two are not one and the same. If the owner, Mr. X, brought in cash 1 lakh rupees as capital. Now, how you have to treat that one? You have to treat that like business has taken a loan from Mr. X. Mr. X withdraws some money from the business for his personal use. Now, how we have to treat this one? We have to treat this one like business has given a loan to Mr. X. See, here we are treating Mr. X as a separate person from the business, even though he is a owner. This is business entity concept. The second one is dual aspect concept. Dual means two, like a coin having two sides, head and tail. Every business transaction has two aspects, the giving aspect and the receiving aspect. For example, I purchased a pen. What happens now? I receive a pen and I pay the price, that is, say 10 rupees, as two aspects. So while recording transactions, we have to write the two aspects. This is also known as double entry concept. The next concept is going concern concept. This says your business is expected to continue in the near future. What is the use of this assumption? You may get a doubt. This is because if you expect your business will continue in the near future, you will prepare accounts in one manner. If it is visible to you that your business is going to end, there is a closure of the business, then the preparation of accounts is in a different manner. This is the reason for assumption of going concern concept. Generally, in 99.99 cases, we prepare accounts on the assumption that our firm is going to continue in future. That's why we prepare accounts in a normal way. But if there is an identification of closure of business, then how can we assume going concern concept? The firm is going to close, the firm is going to dissolve, then how can I assume going concern concept? It is not possible here. Here we prepare accounts in a different manner. So generally and normally, while preparing accounts, we consider our business is going to continue in future. That's why we prepare accounts in a normal manner. Okay, this is going concern concept. The next concept is money measurement concept. This is very simple. This says whatever event or whatever transaction happens, if it is measurable in terms of money, then record that in your books of account. If we can't measure that in monetary terms, we can't record that in our books of account. This is very simple. The next one is cost concept. This concept is mostly related to assets. This says the cost of the asset is to be recorded at the price at which you have purchased. That is the amount what you paid. You get a doubt. Generally we do like this. Then again, why this concept is mentioned here? Because market values are considered in some special situations. That means you purchased an asset. The cost is 1 lakh rupees. But in the market, the cost is 2 lakh rupees. What amount you have to show in your books? Generally, the cost amount, not market amount. Generally, the cost value, not the market value. Hope you understood this. This is the cost concept. The next one is accounting period concept. What is this? You may continue business for 60 years or 70 years or infinite time if it is a company. Will you show your profit or loss after 70 years? After 60 years? No. There should be some period to calculate our profit or loss. Okay. Generally, this period is considered to be 12 months, either from January 1st to December 31st, a calendar year, or from April 1st to March 31st, financial year. This is the accounting period concept. Means an accounting period means generally 12 months. The next one is accrual concept. What this says? This is an interesting topic. This says recognize revenue and expenditure whenever they are earned and incurred. Receipt and payment of cash is not necessary. What this means? This means if you sell stock worth rupees 5 lakh, your customers paid 3 lakh rupees immediately. Then how much sale you have to record? 3 lakh or 5 lakh? You have to record 5 lakh as sale amount. That is your revenue, not 3 lakh. Because of some reason, you have not paid salary for 6 months. What to do? Whether you have to write that expenditure in your books or not. You have to write that expenditure in your books. Even though if you don't pay cash, you have to write that expenditure. The accounting treatment may be different, but you have to recognize revenue and you have to recognize expenditure irrespective of cash receipt and cash payments. The treatment may be different, that is true, but you have to mention in your books of account. The next concept is matching concept. What this concept says? What is matching concept? This says you have to match revenue of this year with expenditure of this year to get profit or loss of this year. Understood? Why, sir? Generally we do that only. No. In our accounting records, we enter each and every transaction, whether that may be related to previous year or latter year, and similarly expenditure that related to previous year and expenditure related to the next year. All these things are included in our transactions. That's why we need to separate them to get our present year's profit or loss. Let's see an example. Your business has a vacant land and you gave that for lease, for rent. They gave you 2 years rent in advance. You received cash and you entered in your books. Fine. But was that income, was that revenue related to this year? No. So we need to separate them. Similarly, you paid salary of 6 months in advance to some officer. You paid, so you record in your books. That's okay. But is that expenditure related to this year? No. Then, if that expenditure is not related to this year and that income is not related to this year, then how you consider those items while calculating profit or loss for this year? So you have to exclude them. That's why adjustments arises. The next concept is realization concept. This concept goes close to cost concept. What this concept says? This says recognize revenue, that is income, whenever you realize that amount, or if you are legally entitled to receive that amount. For example, somebody gave you an advance to supply 1 lakh units of a product X. You received that amount. Now you have to record that as liability, not revenue. Why? Have you supplied goods to that person? No. Until the sale is effected and you are legally entitled, you shouldn't recognize that as revenue. Hope you understood. Only after the sale is completed, only after your service is completed, then only you have to recognize any advance amounts as revenue. Here also, receipt of cash, payment of cash is not necessary. Completion of sale, completion of service is necessary, and your legal entitlement is necessary to recognize revenue. These are the accounting concepts. If you have any doubt, please leave it in the comment section. If you like the video, give a like, share the video, and don't forget to subscribe. If you hit the bell icon, you will get notified whenever I publish a new video. This is for today. Thank you for watching. Let's meet in the next video. Till then, bye.